name's Ryan Knabush from the University of Toledo. Just learning what research needs to be done. Like it's invaluable experience. It really is. It's nice to know especially what the CFA expects from a student. It's nice to know what to prepare for. My personal plan is to take the CFA exam, so it's nice to see how this works out. Harder. There's a lot of work that goes into it, and finding information is not easy. It really isn't. And fortunately, we have some resources on campus at Toledo that help us out. Kind of like I said before, it gives me an idea of what I should focus on, like what sort of classes I need to finish taking, what I need to focus on my studies for the CFA exam, and those sorts of things. Absolutely. Absolutely. I mean, we sat in on Herman Miller's investor presentation, actually visiting the facility, listened to earnings calls and analyzing balance, financial statements. It's certainly real world. It's real. First off, I'd like to introduce ourselves at the University of Toledo. My name is Ryan Knabush. This is Greg Galbraith, Sean Liu, Kevin Wright, and Alex Petit. Also like to thank the judges for being here today and allowing us to do this. We'll start our presentation with our recommendation of hold. Now our price target is $23.41. It's a one-year price target. Herman Miller closed at $21.52 yesterday. So as you can see, it's a very, very small appreciation, just over 8% over the course of 1 year. Now what we're going to cover today is right here, our market profile, business description, markets and distribution, competitive stance, valuation, risk to our price target, a Monte Carlo simulation, and a sensitivity test. Now jumping into it, our market profile here. A couple numbers I'd like to point out to you. First is the debt to total capital of 55%. Now this number is trending downward. A couple years ago, 2009, Nemshoff was Herman Miller's acquisition. They increased their debt load significantly to make that purchase. The other number, return on equity, 50%, is also trending downward. Now what does Herman Miller do? Herman Miller is a manufacturer of high quality office furniture and medical furniture. Now Herman Miller has a very green sense. Sustainability is something that they focus on heavily, and they're actually well renowned for that. They've won quite a few awards. It's kind of a point of pride for Herman Miller. With that, I'll give it to Kevin.
Thank you, Ryan. I'm going to jump into the global market share of the office industry. Now, 5 companies own the top 25% of this market share. And of those 5 companies, you can see Herman Miller is at the top with 6.8%, along with Steelcase at 6.9%. Now, of that 6.8%, Herman Miller is broken up into 3 segments of revenue. As you can see, we have our U.S. government office spending at 53%, our healthcare at 24%, and our international at 23%. Now, when we look to the future, we see growth in every one of these segments. We see our biggest growth in international sales at 28%. We see this because they're in the process of acquiring China-based Posh. Now, Posh puts Herman Miller at a strategic advantage in a growing market that is China and India. They'll gain 30+ dealerships and showrooms throughout this market. As you can see, that's significantly more than H&I and Steelcase with a presence in this region. Now, worldwide, Herman Miller has over 700 independently owned, independently contracted dealerships and showrooms. And they have over 260 just in North America alone. Now, they can do this because they have a well-maintained and well-organized distribution network. Now, to continue with the competitive advantages, I'm going to send it to Alex here.
Thank you, Kevin. Okay, let's take a look at Herman Miller's competitive stance. How do they compete? How do they set themselves apart from the competition? 2 primary reasons, as you see here: operational excellence and their dedication to research and development. You see here a picture of a production line within Herman Miller's facilities. In 2002, Herman Miller partnered with Toyota. And I'm sure you've heard of the Toyota production system, and Herman Miller has implemented a similar system they dubbed the Herman Miller production system. What this allows them to do is allows them to scale their operations accordingly to market. Whether it's a down market, they're able to weather the storm, and whether it's an up market, they're able to leverage their opportunities and take advantage. We see this as a big advantage going forward. Moving right, we see their dedication to research and development. And on average, per year, Herman Miller spends 3% of its sales in R&D, which translates to about $50 million. What they can do with this is they set the trend in the marketplace, and this is particularly important in this day and age where 23.8% of the U.S. demand was in foreign imports, particularly from China and India. So they're able to differentiate themselves and defend against competition. On the right here, you'll see a graph of the R&D spending of U.S. companies, and you can see Herman Miller and Steelcase spending significantly more in R&D. I know we're in a room with Steelcase, so what about Steelcase? Because they look like they compare here. But I think it's important to note on a relative basis, Herman Miller spends two times as much per sales, so per business size, than Steelcase. So really, it's more. So sticking with the theme of sales, I'd like to pass on to Sean to tie it together with our evaluation.
Thank you, Alex. I would like to give an overview of our valuation. First, we have four models: free cash flow model, economic value added model, price to earning multiple, and price to sales multiple. As a reminder that all our models are equally weighted, which gives us a target price of $23.41. Let me take you through the tree of valuation here. We started at the bottom by forecasting sales. This is a current revenue breakdown from fiscal year 2011. We have different growth rates for each sector, and with the weighting in each sector, we have a weighted average growth rates annually at 3.11%. It also explains the future segmentation that Kevin have showed earlier. What it means is the international are growing faster, and it is growing the fastest among the three, and U.S. government and office is growing a little bit slower than that. Moving on, we have thought about how Herman Miller can grow by itself. We do not believe that a 46% sustainable growth rate to be feasible. We actually modified a little bit to use the internal growth rate at 8.5%. Moving on, the next graph shows you our past and projected sales into the future. You can see three distinctive phases here. We're currently in the first phase, where the demand usually limits growth, and for that reason, we have a market growth rate of 3.11%, as I mentioned earlier. Next phase is an expansion phase over there. In that period, we have company growing as fast as they can to meet market demand. And in the third phase, we have company profitability and the market demand both contract at a rate that we projected to be 11.6%. From year 11 and on, we have a terminal rate of 5.8% going to infinity. So since we have the sales projected, we went back to the valuation tree. You can see on your left, we employed the operating leverage concept to get the net income, which feeds into our free cash flow and price to earning multiple. On your right, it's the economic value added model and price to sales multiple. At this point, I would like to turn to Greg to talk about the risks to our target price and Monte Carlo simulation.
All right, thank you, Sean. All right, our first slide shows that the risks to our target price, the fundamental variables to our valuation models we consider to be our growth rates, operating leverage, and weighted average cost of capital. But during the course of our research, we found the key risk factors to our growth rates were coming from fluctuations in crucial demand drivers for the office furniture industry, namely unemployment and corporate profitability. And additionally, we felt with the existence of a highly volatile business cycle within this industry, put added importance on the concept of operating leverage. Now, while Herman Miller's management has done a great job to mitigate that particular risk through, like Alex said, the lean manufacturing and lowering fixed costs, we still feel that operating leverage going forward will be a great measure for future profitability in our projected future business cycle. And finally, we see future volatility in interest rates as a possible risk to the weighted average cost of capital, and therefore another risk to our price target. Now, we did successfully manage to quantify these risks through the use of Monte Carlo simulation. And the results of our Monte Carlo simulation showed that within one standard deviation, our final target price could go to as much as $28 given optimal conditions, and as low as $19 given the least favorable conditions. In addition to the Monte Carlo simulation, we ran a sensitivity test the sensitivity test on our free cash flow and economic value added models shows how any percentage change in the individual risk variables will affect our final target price. And with that, I'll send it back to Ryan to wrap things up.
All right, again, to reiterate our position, our recommendation is to hold Herman Miller with a price target of $23.41. Now, you saw what Herman Miller does for their line of business. You saw how they differentiate themselves. You also saw how we value the company, as well as some risk to that price target, and a couple of simple tests to see what would happen when something with that number. I'll open up questions.
You know, I like the analysis, but I don't own Herman Miller right now. So hold, I'm looking at, you know, where I like the analysis, I like the story. Do I buy it here? Do I wait for that pullback to 19? I mean, does the modeling that you suggest, you know, a price floor, a valuation floor at 19 that I want to enter the stock, or, you know, where would I look at selling it? Okay, I am not an owner of this stock right now. Where do I want to either buy it, or where do I want to sell it? You're saying I'm at a middle valuation point right here. Where are my decision points?
I would like to answer that, if I will. If you see that up here, we are in the middle of the first phase here. So really, we're looking at 2 years down the road where the growth is limited by market demand. So I'll suggest to buy the market, if you do not own it now, to buy the stock before that we hit expansion phase, which is the second phase here that has a growth rate of 8.47%. At that point, the stock will really take off. And if you really, if you have Herman Miller stock right now, if you go to the, never mind. If you have Herman Miller stock right now, we have a upper limit as of to the target price. If given the most favorable condition, the target price we have $23 is about the mean of the conditions. So if given everything turns out to be great, more than great, we could be looking at top line valuation at $28. So at that point, it should be selling.
Can you touch a little bit on the real estate market and its impact on Herman Miller's business, both in the U.S. and potentially as they're making, as they're expanding in China in particular?
I'll take that. They do not like to own their own manufacturing. They like to lease. They see a point in the market where they would rather lease a facility than own a facility. And in China, they already lease a facility in China that can distribute to the companies such as Posh. And looking forward in real estate, at some point it's going to have to recover. And I think they're just waiting for that recovery to put a stability down in a market like China and in the UK and across America. But overall, they're in the leasing part of the business. I don't know if that completely answers your question.
From the real estate perspective, it is the growth in commercial real estate and office space. Can you comment on that relative to demand for their product?
They have an office space. They have a 13% vacancy rate right now in the U.S. Was the number that I found. So I think.
One thing that Herman Miller noted when we visited their facility was that when rent rates go down, it's favorable for them because people move to different offices. And regardless of what level the real estate's at, as long as the rent rates are lower or trending downward, that pushes their demand up because when you move to a new office, you naturally want to buy new furniture.
Right, so I'll tie that in, if I may. I'll just tie that in quickly to our other crucial demand drivers, unemployment and corporate profitability, along with the real estate. Really the three of those, as they drive the market, drive this whole industry, creates the cyclicality in the industry, very, very tied to the overall economic situation.
I would like to make a final comment, as I am more familiar with China market. where I grew up. So actually in China right now, the residential real estate has been very strictly regulated. There's no room for operating in that segment of the market. But therefore the money actually flow, the investments flow to commercial market, commercial real estate very much, to a great deal. Therefore, we do see a very large increase in the coming years in China commercial real estate market.
With the slowdowns that we're seeing in government spending, at both the state and national level, how concerned, I mean, we've got our issues over in Europe, how concerned are you with the slowdown in spending by government agencies on facilities and staffing, and what could that have as an impact on a company where this is a pretty substantial part of their business model?
If I may, I think what Herman Miller's trying to do, and they're seeing the same trends as everyone else is, and I think strategically, in going to their facility, listening to their CEO and CFO, they're strategically placing themselves knowing that the market in the U.S. demand, government spending is going down. So that's why we predicted and applied it into our models of employing an international look with the strategic alliance and now acquisition of Posh, and additionally into their other markets in Europe and Australia. So I think that's as a strategic method, they're shying away, I think, at least knowing there's going to be a slowdown, and I think that mitigates some of the risk going forward.
And they have contracts with the U.S. government. And I think, so kind of what Alex said, they're expecting to see some of these contracts decrease. Because right now they do have contracts to furnish whatever offices that they need. But I think that in the future they're recognizing that this is going to slow down. With deficit spending in question, what Alex said, kind of went along with that and noticed that, and that's what they want to do.
If I may also, in this section, maybe that I wasn't that clear, but in that segment there are U.S. government and there are corporate offices demanding in that section, and largely based on our valuation, we largely see growth from corporate side, and the recent rally of continuing decrease employment rate actually reflect that corporate has been adding a lot of jobs month over month.
Can you comment at all on their European exposure and what impact they may have on their business given the economic slowdown in Europe?
Their market share is actually
market share is good. They're based in UK, so they're not really tied to the euro. They're more in the England and UK area. So they still feel it, of course, but it's not as much as they would. They were more based in the Europe and the euro currency.
Outside of Asia and India and this Posh acquisition, are there other emerging markets they're looking at to get into?
Yes.
Yeah, they mentioned Eastern Europe in particular was really the only thing that they mentioned in their presentation. At this point, they're not targeting any specific company sort of acquisition because that's kind of their method of growth is through acquisition. They're not targeting anybody in particular, but they are looking to establish a presence there.
And I think continue funding acquisitions through cash flow.
And I think yes. In addition to that, I think when we take a look at their 10K, their recent 10K filings, their fiscal year 2011, they mentioned they have operations within emerging markets in Brazil, the South American markets as well. So I think they're looking at just to kind of diversify themselves, and I think they're doing the right job. And I think going forward, I think they're going to be all right. But they haven't mentioned any specific ones as of yet.
Yes, also, as for Posh, we have mapped their presence in China and India, but that's not all of their presence in Asia and particularly Southeast Asia. They also have dozens of dealers in Indonesia, Malaysia. I know Malaysia is having a terrific year, nationally speaking.
Thank you.